Rahul Chadha, Head of Asia Pacific Investment Division with Mirae Asset Management, joins us live from Hong Kong. Rahul, morning. Thank you for joining us. Always good to have you back on ET Now. Rahul, what do you think will have an impact on Indian markets most in the next 3 months? Europe, crude, rupee or earnings?
I think clearly much more than anything else, rupee is the most worrisome thing on mind of foreign investors. Most of the regional currencies have depreciated against dollar, but the depreciation in rupee has been particularly sharp, at least 5 to 6% more than the regional pairs. And I think what investors are looking is some bit of measures from government to stop this vicious cycle which is going in the economy, where depreciating rupee feeds on the local business environment, high inflation, sticky interest rates spoil the investment climate. So clearly, I think we've got a limited window before the next parliament session starting, and we want to see government do tough measures to keep the fiscal deficit under control, to give a confidence on the economy from a medium-term perspective.
Rahul, hi, morning. The rupee weakened all the way to 56 plus levels to the dollar. Does it seem like in the near term at least the currency has bottomed out, or do you think there's further pain ahead?
I think clearly if you see the rupee movement, rupee gained after government announced much expected fuel price hike. You need to see some bit of a measure on the diesel price increase. You need to see some firm commitment on keeping the deficit in check, some bit of measures on auctioning of coal blocks or other things which can rekindle the positive investment climate. Else the air of negativity for India remains fairly high, and I think with every passing quarter we can see a lower GDP print.
Rahul, you were just talking about the currency stability and as to how a diesel price hike is, imperative for a move like that, and how the street is really watching out for that one. But given the kind of sensitivity that diesel prices have to the normal public or the layman on the street, do you think the quantum is going to be as steep as was the case with petrol? And do you really think a diesel price hike is going to be able to come about in a political environment like today's?
I think clearly things look tough, but as I said before, there's a limited window for government to take tough decisions, and people understand the need and the rationale for these decisions. The quantum is going to be much lower, but it does more of a signaling effect that the government is committed to managing the deficit and keeping the expenditure in check.
Rahul, but do you think it's time now to buy fear? Because incrementally it is very difficult to imagine what else could go wrong from here. And on the other side, incrementally it is very easy to imagine what else could improve from here. So things which could go wrong, that list is small, and things which could improve, I guess that list is long.
Okay. Nikunj, like the way you said, I think if you take a 2-year view with rupee at 55, 56 to a dollar, markets clearly look attractive. But then one also has to understand the fact that if this current state continues, where inflation is far more sticky, and unless and until we see commodities coming down very sharply, inflation may continue to prove sticky. So RBI ability to cut rates is limited, and what we can see is the real impact of high interest rates now coming into economy, where investment slows down, where consumption slows down, and we continue to have a spate of bad news. Which is why I'm saying that out of these two headwinds which market has, interest rates and policy paralysis, one of these headwinds has to go for market to bottom and head higher.
Rahul, what are the sound bites you're picking up from some of your top institutional investors? Are you getting a sense that they are now worried about their India exposure and they're redeeming some of the India exposure?
No, we've not seen any redemptions in terms of India exposure. Most people believe that India is a good long-term structural story, and again at current currency levels we've been communicating our investors to add to India exposure from a 2-3 year time perspective, but near term is a not function of what government does, because clearly there is a reduction in the risk appetite. India is a current account deficit economy, and the bigger concern which is coming from investors perspective is on currency. Because again, corporate data has been good this quarter in terms of results. Banks numbers were okay, consumption numbers were okay. I think currency is something which is really worrying a lot of people.
So at 4,900 thereabouts on the index, Rahul, how much more downside does the market have from these levels?
Again, it's difficult to call a number over there, because like the way I said, it's really, we are in a chain of a negative cycle, and something has to happen to break this chain. So either we see government coming and announcing a whole lot of measures, you have coal block auctioning, or some of these measures to kickstart the capex, and then the things turn around. So valuation-wise, they look cheap, but they look cheap because we are looking at a last 5-6 years GDP print of a 7.5%. Should this print go to about 5-5.5%, we may see earnings revision being more negative than what we saw before.
But is the valuation attractive enough for long-term investors to start accumulating at current levels? Is that the advice you're giving out?
Yeah, clearly we are doing, but there is no hurry to do the same. So we believe from a 2-3 year perspective, taking 55-56 rupee dollar exposure, valuations are attractive, but whether things bottom out in 3 months or 6 months from now is anybody's guess.
Rahul, just about everyone is of the view that it is time to sell investment-oriented Indian stocks and time to hide in consumer names or consumption-oriented companies. Do you think that trade is now getting too crowded and smart investors now they need to sell out of consumption and revisit investment-oriented stocks?
I think consumption names would have their own growth trajectory, but some of the names are clearly expensive, are 30-35 times forward earnings, and the risk lies that should we see any earnings disappointment in the name, one can easily lose 20-30% of the value. On the other hand, investment names are beaten down, but like the way we've discussed over the last 12-15 months, we need to see a positive action to re-rate these names, else we can see these names getting a bit more cheaper before they bounce back.
So at the current juncture, Rahul, what's been your investment strategy? How much cash are you sitting on?
In our portfolios, we are overweight IT, so IT would be about 20-21% of our portfolios, which is done well because of rupee depreciation. And pharmaceuticals and consumption names are something we are positive on. We are adding to the investment names or industrials on dips. Banks is something where we'll see the rally happening should we see government taking some positive steps. And within banks also, we are focused on the large cap names where NPA concerns are much lower than the public sector peers.
So if you have to analyze Q4 numbers, what is your big key takeaway? Do you think Q1 numbers will be challenging, or you think based on what corporate India has reported for Q4, earnings pretty much have bottomed out now?
I think there is a kind of a dichotomy with this, because rupee depreciation actually benefits the earnings. But what happens is if rupee depreciates, you see the P of the market going down because most investors want a stable and appreciating currency. So if you look at numbers, I think banks would continue to have decent set of numbers, private sector banks and some large public sector banks. Consumption, we may see a bit of a slowdown, but numbers should be okay. I think we would see, poor set of numbers from industrials. This quarter has been exceptionally bad for industrials in terms of numbers. And autos may also disappoint post a mixed quarter in April.
What about banks, Rahul? What's your call then? Do you like any of the PSU names given the kind of NPA history that they've had?
I think banks, again, we've had SBI, which has given good set of numbers. NIMs have been okay, NI growth's pretty decent, and more importantly, NPA accretion has kind of slowed down. But clearly, banks is a function of the economic policy. So if these air of negativity prevails for long, if high interest rates prevail for long, it's but natural that SMEs or the weak corporates would go for again restructuring, or NPA accretion would be much higher than expected. So bank is a much function or a reflection of the macroeconomic health of the economy.
You talked about your bullish stance in IT, Rahul. Besides the currency trade, what do you think is working in favor of the IT pact? Because after the earnings that Infosys came out with, not many people were finding favor with the IT sector.
I think clearly what you've got to see from these companies is Infosys was one of company-specific case. I think we'll see a sector growing around 8 to 12% broadly. And with rupee depreciation, not everything is going to be reinvested in. So part comes in earnings, higher earnings for investors. And also what we'll see is higher dividends, more probably buybacks. And whatever said and done, these are good companies which are available at 13-14 times forward earnings, which is much cheaper than their historical valuations. And I think what we see for them is a temporary blip in growth. I think should things kind of get okay in a year or two, they'll go back to their normal 15-17% growth trajectory.
So what all do you like from the IT pack?
Difficult to take names on that, but we like pretty much the top 3 names and let's say the leading company which is listed overseas. So pretty much the top 3-4 names.
2 companies which are listed abroad.
Sorry?
That 2 companies or 2 large IT companies are listed abroad. Do you like both of them?
In fact, we have, as per the last disclosure, Cognizant in our portfolios.
Okay. Rahul, technically and fundamentally, it's very easy to make a bearish case for India. But if I map what foreign institutional investors have done so far this year, they've pumped in about $8.5 billion. That is some kind of a record inflow. Are you a bit surprised? Are you a bit delighted that in such a sticky environment, foreign institutional investors, they are not losing their faith?
I think clearly it's a positive surprise. And if you ask me, I've spent a week in China just in the second fortnight. And clearly, if you look at the breadth of companies you find in India, they're much better across sectors. The corporate governance is better. You get a good mix of companies. And in an environment where you see growth in China slowing down, ASEAN, again, is a very small exposure. Indian companies stand out. So I think what worries investors from making India meaningful overweight is the poor state of macroeconomic health. Should things improve over there, I think we can see sizable flows into the economy because it's a much more robust structural story. Clearly, again, we've been expecting the government to do a lot of things for the last 2-3 years, but they've just passed.
I would also discuss the implications of the popular phase, which is risk on and risk off. Historically, every time we have seen risk off, crude, asset prices and emerging market equities, they always move in a synchronized manner. Similarly, every time we've seen risk off, crude, emerging market equities and metals, they always correct in a synchronized manner. So if crude goes up, India goes up. If crude comes down, India also comes down.
I think you can talk on that, but probably our belief is that this time around with more meaningful slowdown happening in China, things should be different. I mean, over the last 5-7 years, China has been at least 50 to 70% of incremental demand for most base commodities. Crude is a difficult call because a lot of financial money also gets parked over there. But should we see global growth slow down, that should also correct. And that should be beneficial for India. In fact, we've already seen from the peaks a correction of nearly 12 to 14% in crude oil prices. Unfortunately, that's been nullified by rupee depreciation, which is where the core argument comes, that we need to give confidence to the investors that the government is not going to do excessive money printing, is going to keep the deficit under control, which automatically keeps the inflation under check. And consequently, we'll see investors, both portfolio and FDI, direct investor, trying to finance this current account deficit. Else it just becomes difficult because people are unsure of government policies in the near term, and you don't see any financing of this deficit, which leads to excessive rupee depreciation, which again scares the people who are already invested in the country.